You just bought a house. Congratulations. The keys are in your hand. You're standing in the living room thinking about all the possibilities. New paint, maybe a kitchen renovation, finally having space that's actually yours. The realtor is left. The paperwork is signed. You did it. You own a home. Then the first bill arrives. Not the mortgage. You knew that was coming. You'd already done the math 100 times. This one is different. It's from the county. It's for property taxes on a house you now own outright. Your initial reaction is confusion. You already paid for this. You paid hundreds of thousands of dollars for this during closing. Your lender required an inspection. You paid for a survey. You paid for title insurance. Why are they asking for more? You call someone, a friend, maybe a family member who's been through this before. They laugh. Not unkindly, just the laugh of someone who's already learned this particular lesson. Yeah, they say, welcome to property taxes. That's forever. Forever. But here's the thing nobody mentions at closing, and almost nobody walks you through clearly. That moment, right there, is when home ownership shifts from an asset into something that feels less like ownership and more like a very long rental agreement disguised as freedom. And the trap isn't just property taxes. It's far more elegant than that. Let me be direct about what's happening right now in the housing market, because it's important context for understanding why the trap is so effective. Home prices have nearly tripled in most American cities since 2000. In major metropolitan areas, New York, San Francisco, Los Angeles, they've quadrupled or more. Mortgage rates have climbed back above 7% after spending a decade in the 3 to 4% range. The median home price in the United States is now pushing close to $500,000. In coastal markets, you're looking at $1 million plus easily. And yet, and this is the crucial part, people keep buying. Not fewer people, more people. Even as prices climb and rates rise, the housing market remains competitive. Bidding wars, cash offers, people stretching their finances to the absolute limit to buy something before prices get worse. Not because they're irrational, because the narrative around home ownership in America has calcified into something almost religious. You hear it everywhere, from your parents, from financial advisors, from your friends who bought before prices got insane. Buy a home, build equity, stop throwing money away on rent. It's the American dream. It's the path to wealth. It's what you're supposed to do. The dream is real. The math behind it? That's where things get slippery. Here's what happens in the first moment of home ownership that nobody walks you through clearly, and I mean almost nobody. You sign a 30-year mortgage. Let's say it's for $350,000 at 7% interest. Your lender calculates your monthly payment, and it's about $2,330. That number feels manageable when you're standing in the bank or on Zoom with your loan officer. That feels like a plan. That feels doable. But when you do the arithmetic, and almost nobody does this before signing, you realize something genuinely unsettling. By the time you make that final payment 30 years later, you will have paid approximately $840,000 for a home that originally cost $350,000. You've paid more than double the original price of the house. The bank has made roughly $490,000 in interest alone. That's not equity building. That's not you gradually becoming an owner. That's interest accumulation, dressed up in the language of wealth and investment. Now, the counter-argument is immediate and reflexive, and it's what every financial advisor and real estate agent will tell you. But you're building equity. Your payment is going toward ownership. And that's technically true, mostly true, legally true. But let's be precise about what that means. In year one of your mortgage, out of that $27,960 in annual payments, roughly $8,000 actually goes toward paying down the principal, building equity. The other $19,960 goes to interest, the bank's cut, the cost of borrowing $250,000. In year two, it gets slightly better.
maybe $9,500 toward equity, $18,400 toward interest. The math is glacial. It takes almost 8 years before half your monthly payment is going toward the principal. Only then does homeownership start to feel like ownership rather than obligation. But the mortgage is only the foundation of the trap. It's not even the biggest piece of what makes homeownership feel like a trap.
Once you own a home, legally, officially, with the deed in your name, you enter a system of costs that don't exist when you rent. And here's where the complexity becomes almost architectural. These costs are staggered, invisible, and deliberately designed so you never see the full picture all at once. You discover them gradually. You adapt to each one. By the time you've adapted to all of them, you're locked in. First, there are property taxes. These vary wildly by location and state, but let's use realistic numbers that apply to most of the country. In most states, you're paying between 0.5 and 1.5% of your home's value every single year to your local government, forever. If you bought a $350,000 home, you might pay somewhere between $3,500 and $5,250 annually in property taxes, depending on where you live. That's just the baseline. But here's what most people don't fully reckon with. That number doesn't stay static. Property taxes don't stay flat. They increase, sometimes modestly, a few percent year over year, sometimes aggressively, in jumps that feel arbitrary, but are actually tied to assessed value increases or local budget decisions you have no control over. Over 30 years, that $3,500 annual tax can easily become $7,000 or $8,000. You're not just paying the original cost, you're paying an escalating obligation. Most homeowners don't think about this the way they should. They absorb the first tax bill, adjust their budget, and move on. But add it up across 30 years, and you're looking at $420,000 to $630,000 in property taxes alone, assuming conservative growth. In some states, it could be more. And here's the architectural cruelty of property taxes. You can lose your home if you don't pay them. Not your bank taking it for mortgage default, though that can happen too. The government can take it. The entity that's supposed to provide you services, that's supposed to protect you, can remove you from your property if your tax payments lapse. You're essentially renting from the government while also paying a mortgage to a bank. Second, homeowners insurance. Your mortgage lender requires it. You can't get a loan without it. It protects the bank's asset, which for most of the loan term is them, not you. Insurance costs usually run between 1 and 1.5% of your home's value annually. On that same $350,000 home, you're looking at $3,500 to $5,250 per year. Add that to property taxes, and now you're looking at $7,000 to $10,500 annually just for the privilege of maintaining the privilege of ownership, before a single repair happens, before anything breaks, before a storm or flood or fire. And insurance premiums aren't stable either. They climb. Some years they jump significantly, especially if you filed a claim or if disaster has struck your area. If your home has damage, even minor damage that required an insurance claim, your rates might jump 20% the next year. Some insurers will drop you entirely. Third, and this is where the comparison to renting becomes almost darkly funny, maintenance and repairs. This is where renters have an almost criminally underrated advantage that nobody mentions in the homeownership sales pitch. When something breaks in a rental apartment, you call the landlord. You don't pay anything beyond your rent. When something breaks in your home, you're writing checks, significant checks, 5 figures, sometimes 6. Your roof has a lifespan of 15 to 25 years, depending on the material. When it reaches the end of that lifespan, and roofs don't fail gradually, they fail suddenly, a new roof costs $10,000 to $25,000, possibly more if you have a complex design or live somewhere with expensive labor.
Your HVAC system needs replacement roughly 15 years, another $5,000 to $15,000 gone. Your foundation needs attention, cracks, settling, water intrusion. Your plumbing ages, your electrical system becomes temperamental, your appliances fail. Financial advisors will tell you to set aside 1% of your home's value annually for maintenance. So on a $350,000 home, that's $3,500 per year, $42,000 over a decade. You might need it, you might not, but the possibility is always there, lurking in the foundation, literally. So let's add this up to a realistic monthly picture. Your mortgage payment is $2,330. Property taxes and insurance combined are averaging maybe $800 to $900 per month. Maintenance reserves, if you're actually being smart and not just hoping nothing breaks, are another $300 per month. You're now at roughly $3,400 to $3,500 monthly to live in a house you thought you were buying equity in. Compare that to rent in the same market for a comparable home, $2,200 to $2,500. The difference isn't catastrophic in year 1 or year 2, but it's there. You're essentially paying a premium, $900 to $1,300 monthly, for the privilege of being responsible for everything that can go wrong. The landlord's liability becomes your liability. The landlord's cost becomes your cost.
Here's where the system reveals its actual design, and it's worth spending time on this because most people don't see it until they're already trapped. Time passes, years accumulate. Your property taxes don't stay at $5,000 per year. They climb. In some regions, they climb aggressively. Property values rise. Maybe that $350,000 home is now worth $450,000 or $500,000. Congratulations, you've built equity. The market has rewarded you. Your obligation to the government increases proportionally. It's a tax on appreciation, a tax you didn't ask for but can't escape unless you sell. In some states, this can be brutal. If your home appreciates significantly and your area reassesses property values, your tax bill could jump 20, 30, even 40% in a single year. You didn't borrow more money, you didn't make any changes, the market moved, and now you owe more to keep living in the same house. Meanwhile, inflation eats away at your salary, but not at these obligations. Your mortgage payment is fixed, which is genuinely great. For a $2,330 payment in 2025, you're paying the same $2,330 in 2035 and 2045 and 2055. That's the one advantage of a fixed-rate mortgage in an inflationary environment. But everything else compounds. Insurance premiums creep upward, not by the rate of inflation, by the rate of insurance company cost increases, which is often higher. Maintenance needs don't escalate linearly, they accelerate. In year 5, your HVAC system might be aging but still functional. In year 12, your HVAC system doesn't wheeze, it fails catastrophically. In year 15, your water heater doesn't sputter, it dies, and suddenly you need $8,000 for a replacement. In year 18, your foundation develops a crack that a structural engineer says needs attention immediately. The timing is never convenient. It's never in the year when you're expecting it. And here's the mechanism that makes this a trap rather than an investment. You're locked in. You're geographically immobile. You're financially bound. You can't leave easily. Selling a home requires paperwork, inspections, appraisals, title searches, attorney fees, and agent commissions eating 5 to 6% of your sale price. If you bought for $350,000 and your home is appreciated to $450,000, you'll lose $27,000 to agent commissions alone before you even account for closing costs, inspections, or repairs the buyer's inspector will inevitably demand. You're thinking about moving. You run the numbers. The transaction costs are enormous. The market might be down, or you might owe more on the mortgage than the home is worth. You're trapped. Not legally, not by explicit agreement, but mathematically, by circumstance. So you stay. You fix the roof.
You maintain the system. You pay the taxes. You pay the insurance. You accrue equity, yes, but you've also incurred a dependency. You've become steward to something that stewards you in return, whether you wanted that arrangement or not. This is the trap. Not the house, not the concept of ownership, but the system of obligations and costs that make leaving nearly impossible and staying increasingly expensive. Now, here's where the story refuses to simplify, and it's important that we sit with this complexity because the truth is genuinely complicated. Home ownership is still, in many cases, a mathematically superior choice to renting over the long term, if you stay in the home for 10 years or longer, if you buy in a market where appreciation is happening, not speculative bubbles, but real, sustainable appreciation. If you don't experience a catastrophic repair in year 3 that drains your emergency fund and forces you into debt. If property taxes in your area don't spike dramatically. If mortgage rates don't reset on an adjustable rate mortgage. If you have stable employment and don't need to relocate for a job. If you face a personal crisis that forces a fire sale. If you have enough cushion in your finances to absorb the unexpected. There's a lot of if. And the conventional wisdom, renting is throwing money away, is also not entirely wrong. Every dollar you pay in rent evaporates into the landlord's pocket. It doesn't build equity. It doesn't create an asset. But every dollar you pay in maintenance also evaporates. Every dollar in property taxes also disappears. Every dollar in insurance that never results in a claim also vanishes. The language around building equity makes home ownership sound like a guaranteed wealth strategy. It's not. It's leverage. You're borrowing money at 7% interest to purchase an illiquid asset that requires ongoing costs most people underestimate. For some people, in some markets, at some times, home ownership is the right financial decision. For others, it's a trap. And the problem is that you don't know which category you fall into until you're already committed.
The dream wasn't designed by banks. The American dream of home ownership is real and deeply human, but the mortgage system was designed by banks, and they understood something that most home buyers don't. If you can make someone's monthly payment manageable, they'll do almost anything to keep the property. They'll maintain it. They'll pay the taxes. They'll accept the obligations. They'll stay. Here's what's genuinely insidious about the whole structure. The banks understand this mathematics perfectly. They understand that you'll stay for 30 years because leaving is expensive. They understand that you'll manage the roof repair because you don't want the home to deteriorate and lose its value. They understand that property taxes are inescapable, which makes them lower risk than commercial investments. They've created a system where your obligation is nearly permanent, where your monthly payment can be adjusted into your budget, but the full cost of ownership remains invisible. You're not a customer buying a home. You're a revenue stream, a 30-year contract where the house is collateral and your monthly payments are guaranteed because you'll do almost anything to keep a roof over your family's head. The implications of this system ripple outward in ways that almost nobody discusses in real estate conversations, but they're important to understand because they affect entire societies. Home ownership is designed to be generational. You buy, you stay, you pay. You eventually sell or leave it to your children. This creates extraordinary wealth inequality that persists across generations. If your parents bought a home in 1990 for $150,000 and that home is now worth $600,000, you can inherit an asset worth more than most people will earn in their lifetime. You didn't work for it. You didn't earn it. You inherited it, but it's yours. And that home might be paid off. Your parents' forced equity building becomes your windfall. If your parents couldn't afford to buy because of redlining, because of historical discrimination, because of poverty, because of circumstance, you don't have that inheritance. You start from zero, while your peers start with a 6-figure asset.
Homeownership is also designed to be geographic. You buy in a location because you can afford it, because you have a job there, because your family is there. You become invested in that area. Schools, communities, political climates, local infrastructure. You're no longer footloose. You're tethered to the consequences of local governance, local property taxes, local real estate booms and busts. You can't easily relocate for opportunity. You can't easily escape if your city's economy collapses. You're bound to place in a way that renters simply aren't. And perhaps most importantly, homeownership is designed to be consuming. A significant percentage of your income goes toward housing. The percentage grows as your income stays flat or grows slowly, while your property tax, insurance, and maintenance obligations climb. This means less disposable income, less money for other investments, less financial flexibility, more dependence on continuous employment, more vulnerability to economic disruption. One medical crisis, one job loss, one unexpected repair, and the entire structure can collapse. The system doesn't want you to think about this. It wants you to think about equity, appreciation, and the American dream. Those things are real, but they exist inside a structure that's remarkably effective at capturing a huge portion of your economic life and channeling it toward obligations that never quite end. So here's the question that won't leave you alone after you've really looked at the numbers, after you've understood the structure. Is home ownership an investment you're making, or is it a commitment you're making to stay in one place and pay for the privilege indefinitely? Because the answer to that question, really sitting with it, thinking about it clearly, changes everything about how you approach the decision. The house is real. The equity is real. The wealth can be real. The memory and the stability and the sense of ownership, all of that is real. But the trap is also real. And it's elegant because it's made of the things we value most: stability, community, security, ownership. The system isn't evil, but it's not accidental either.